Regarding depreciation, we must distinguish economic depreciation and accounting depreciation. Economic depreciation is the one that you use when you calculate net domestic product, and it reflects the real loss of value of the economic assets. Whereas accounting depreciation is just a process of allocation of the cost to the expenses. So you're moving the cost of the asset into the expenses. When we talk about accounting depreciation, it's only an estimate. So whatever method you use, you may get different estimate of depreciation, accounting depreciation. And it doesn't mean that any of these methods are wrong. Of course, you must use them consistently. If you selected particular method of depreciation, then continue using it. If you decide to switch to different method of depreciation, you need to explain why you are doing this. Of course, some methods of depreciation may be applicable to particular asset. It depends on in what manner the asset is losing its value. For example, if it is a building or some structure, it loses the value gradually and uniformly, same amount every year. In this way, you will use straight line method of depreciation. If we talk about some high-tech asset, like a computer or some high-tech equipment, every year or every 2 years, there will be new type of equipment or high-tech stuff appearing. So therefore, the old one will get obsolete. So therefore, you need to depreciate it quickly. In the early years, you will perform more depreciation. So in this case, for these high-tech assets, you will use diminishing balance method of depreciation. If you have equipment that works irregularly, 1 month it works a lot, next month it does not work a lot. Therefore, the loss of value will not be regular as well. So in this case, you use units of production method. More units are produced, higher will be depreciation. Fewer units are produced, smaller will be depreciation. So you must decide what method is the most appropriate. Of course, when you do depreciation, you need to know the value of historical cost, and we just talked about this, what to include in the historical cost. Secondly, you need to know whether there is a residual value or there is no residual value. There may be both possibilities, just read the question carefully. And the third one, you need to know the depreciation period. So it will be again based on the estimate, the useful life of the asset. For example, if it is a building, particular type of the building, then the useful life may be 50 years if it's a wooden building, and if it's a brick building, can be 100 years. If it is a car, maybe 20 years, and so on. But of course, it will be different from the true economic life of the asset. We all know there are certain cars that are fully depreciated and have no value in accounting sense, but they're still running and people are driving them. So they have economic value and they have much longer economic life than the accounting and useful life of that asset. So depreciation would be applied. It will not be applied to land, but it will be applied to land improvements, to buildings and equipment. The depreciation does not apply to land because land does not lose its value over time. In fact, the value of the land may be increased if you put fertilizers and if you treat the land well. So therefore, land is not a depreciable asset, but other assets, they will lose the value over time. And it's not only about the loss of value, loss of the productive capacity, but it's also about the fact that the asset may get obsolete. Obsolete means morally outdated. So it is still functioning, it is still okay to run, but it's just too old and not modern. For example, some old airport that was built, say, in 1950s, it can still the airplanes can still land on this airport on the landing lane, but just too old. There are much more modern airports appearing. This example here in this frame.